Learning Objective 5-2, make calculations and prepare consolidations for the consolidation of a partially owned subsidiary where there is complex positive differential. So we're going to continue with the same example. And here we have income for 2021 and 2022 for Peerless products and for special foods. And we should note that we write up the entire company even though Peerless is only buying 80% of it. So the non-controlling interest is sort of along for the ride here. And what the non-controlling interest gets is they get a write-up of their assets, even though, so we write up the 100% of the assets, even though Peerless only bought 80%, meaning that the non-controlling interest assets also get written up, even though the non-controlling interest hasn't changed. And it's kind of a weird thing. It is, in a way, it's an exception to historical cost. Historical cost says you record things for what you paid for them. And here, the non-controlling interest paid some smaller amounts. But what we say is that based on the entity principle, this is one company, and we can't treat 80% of the company differently from how we would treat 20%. So you would not write up 80% of the assets and leave the other 20% alone, because it's really just one company. So here's the basic information that we have, and the first thing to do is to record income under the equity method. So that will be debit investment in special food stock for specials income times 80%, and credit income from special foods for $40,000. And that would be the share of the income. Then for the dividends, we would debit cash for our share of the dividends. That would be $30,000 times 80%, or $24,000, and credit investment in special food stock for $24,000. And then finally, we have these various write-ups and write-downs. So what happened was that the inventory has been written off, and that is a $5,000 write-up, of which we get 80%. The buildings and equipment needs to be depreciated, so our share of the income, remember the buildings and equipment was written up, and we can't just forget about that. Under the equity method, if you're going to write up the buildings and equipment, then you need to record the additional depreciation on the write-up. So there's a $60,000 write-up on the buildings and equipment, if you remember, and it's depreciated over 10 years. So that'd be $6,000 a year depreciation, times 80% would give you $4,800. And the same thing with the goodwill. The goodwill in 2021, the company determined that goodwill was impaired by $3,125. The parent's share of that is 80%, or $2,500. So the parent needs to record an additional $11,300 in expenses, because these are on the write-ups that the parent recorded, and Special doesn't know about the write-ups, right? Special keeps going along as if nothing happened and has no idea that inventory is written up, buildings and equipment, there's goodwill. Special has no idea about those things, so they're not reflected in Special's books, and therefore they're not reflected in Special's income. Peerless needs to account for those separately. So this $40,000 credit income from Special Foods only accounts for what's on the books of Special. And these other write-ups, and if there were write-downs, need to be accounted for separately by the parent in this equity method entry. And this is called the fully adjusted equity method. And the truth is that the parent doesn't need to use this method. They could use any method they want. You can make up your own method if you want, as long as they can eliminate whatever they did in the consolidation. What's better about using the fully adjusted method, and why it's a good practice, is because this will approximate, this should be equal to the real consolidated income, so that the parent's income under the fully adjusted equity method should equal consolidated net income if everything was done properly. So we need to reduce this income by $40,000. And I don't debit cost of goods sold, depreciation, impairment of goodwill, because on the parent's books, all of the income from Special Foods appears in this one account, income from Special Foods. So since I recorded $40,000 in income from Special Foods, now I would need to reduce it by the additional expenses, which in this case are $11,300. So I'm going to debit income from special foods and credit an investment in special food stock, in essence reversing the first journal entry for $11,300, like so. And here you can see income from special foods on the books of Peerless is equal to $40,000 minus $11,300, or $28,700. Next, another year goes by, and we're going to have consolidation at the end of the second year. So again, I'm going to debit for the income, I'm going to debit investment in special food stock. In this case, it will be for 75,000 times 80%, and credit income from special foods, 60,000. For the dividends, I'm going to debit cash for the amount of dividends received. For the parent is going to receive 40,000 in dividends times 80%, or $32,000, and then credit investment in special foods stock. $32,000. And then I have these various adjustments again. So the thing is, there is another goodwill impairment, so we don't have to worry about that. The inventory that was written up has been completely sold last year. So there's only one item left to worry about with the differential, and that's the depreciation. And the depreciation on the building, again, is going to be $6,000. It's $6,000 a year times 80%, $4,800. That's the only thing we have to worry about. And again, this is not the journal entry debit depreciation expense credit accumulated depreciation, because the income from special was recorded here on the books of Peerless. So therefore, any additional expenses is going to be is going to go to income from special foods and investment in special foods. So I'm going to debit income from special foods for $4,800. That's $6,000 times 80%, and debit investment in special food stock for $4,800, like so. And now we do a whole nother consolidation. And the helpful thing, what you might want to do here is you might want to pause the video and try this out yourself, because it's the same basic thing. It's just going to the next year, and then if you can do this, then you pretty much know what you're doing. The first thing to do, if you want, what you can do is, after I say first thing to do, you can try it, then turn off the video, pause the video, try it, and then restart the video to see if you got it right. Let's start off with a big journal entry here. And I'm going to debit the parent's share of the income of the sub. That was $60,000 to income from special foods. And the non-controlling interest is going to get their 20% share right here of $15,000. And then I'm going to debit retained earnings to the sub for $120,000, beginning retained earnings, and I'm going to credit dividends for $40,000. That's the beginning of the big elimination entry. I'm making that yellow. I've also got to debit common stock of the sub for $200,000. And then of these items, let's make this small again, 80% is going to be credited to the investment account, and 20% is going to be credited to the non-controlling interest. So that would be 60 plus 15 plus 120 minus 40 plus 200 times 80%, 284. And non-controlling interest would be 60 plus 15 plus 120 minus 40 plus 200 times 20% is going to be a credit of 71,000. So let me make these things yellow so you can see it all in one picture, like so. And this is your big elimination entry. The next entry to do now is to focus on the income statement and whatever additional expenses I need to record. There's only one additional item I need to do this year, and that's going to be the additional depreciation of $6,000. So it's always $6,000 because we're using straight line. Imagine what would happen if you use ACRS, if you accelerated use double declining balance or something, right? That would be crazy. So you debit depreciation for $6,000, and then you credit income from special foods for 80% of that, and you credit the non-controlling interest in income, in net income, for 20% of that. And that's all you need to do there. Because the inventory was written off last year, it was expensed into cost of goods sold, and there is no impairment loss. I still have the line item here in the spreadsheet, but there is no impairment loss. Next, we do our write-ups and write-downs on the balance sheet. So remember that land needs to be written up by, I can just look at last year, right? By 10,000. Buildings and equipment needs to be written up by 60,000. And now accumulated depreciation, you got to really think about this, is going to be $12,000 because it's going to be 6,000 from last year plus the new depreciation that I'm recording this year of $6,000. There you go. So it's going to be 6,000 plus 6,000 at 12,000. And goodwill is going to be whatever it was last year because that took into account the impairment. So these are going to be all the various items here that we're going to be adjusting on the balance sheet. And 80% of these are going to be credited to the investment account. For $53,900, and I go whew, that the investment account is zero. And 20% of them, 10,000 plus 60,000 minus 12,000 plus 93.75. 20% of that would be 13,475. And again, there's work you can do to roll forward the non-controlling interest in net assets of special foods to get that number and see how you got it. And I believe that's in the book. All I'm going to do here is reconstruct income of the non-controlling interest, this $13,800, the non-controlling interest share of net income. Special report is $75,000 in income, but we had to take an additional $6,000 in depreciation because of the write-up. So therefore, adjusted income would be $69,000. 20% of that would be $13,800, and that is the non-controlling interest share of net income.